Good morning, everyone. Ben Driggs here, Navigate Financial with DJ in the background. We appreciate your taking a few minutes with us today for our monthly webinar. We will be together for a half an hour, and we invite you to, for sure today, we want as much Q&A as possible. We hope to have this in, kind of an interactive session, but we put together a presentation that we felt that it would be good to talk about some of the things that are happening today, because certainly what is happening in Iran is impacting the stock market. And so we want to talk about that a bit, but we want to take a step back and also look at the bigger picture. So as a reminder for people who are joining us for the first time, we do this webinar once a month on the second Thursday of every month at 10 o'clock Mountain Time. And we invite anyone who's interested to join us for a few minutes while we discuss topics of the day. So we are going to be talking today about the topic, how current affairs are impacting the economy and how they're impacting your money. If you have any questions, you want to chime in, please send a question. DJ will be monitoring the questions in the chat. But let's go ahead and start today with a question. Year to date through yesterday, the stock market is A, B, C, or D. Now, DJ, can you go ahead and cue that up so they can press that? Are you ready to go for that?
I am. Yeah. So everybody should have seen this question pop up for you. You can go ahead and click on your screen or your phone, whatever device you're using, and vote what you think it will be. We'll give it just a few seconds here. I can see most people have voted. Okay. So
what do people think? A, B, C, or D?
Most people have put between 0 and plus 4%. That is the number one. About 60% of the people have voted for that. And then most of the others are between 0 and -4. I think about 90% of the votes are between those two answers, B and C.
Yep, and it's about flat. It's slightly negative for the U.S. stock market. International markets are up a little bit, but I would say it's C on a more diversified, moderate. If you add in the bond market and the international markets, it's slightly in the black. So it's somewhere between B and C. So nicely done. I wanted to start with this slide to highlight the fact that even though it feels like the markets have gone up, certainly the world has gone up and down in the last 5 weeks with the war in Iran and gas prices and all these things like that. At the end of the day, we're basically flat. And I think that's what kind of what we're going to be talking about. So why does it feel uncertain? It feels uncertain because it is. We live in a very complex world. There are a lot of uncertainties. And I think increasingly, and we'll show some data to support this, there's this growing gap between how people feel and the reality of what is going on when it comes to the economy. But there are some times that the perceptions match reality and the feelings match reality. And parsing out that difference is a very difficult thing that requires a lot of judgment. So on one hand, we have how things feel. And I think most people would agree there's a feeling of anxiousness, uncertainty, AI, and the war in Iran and the political environment and international relations and unemployment, high prices. These all create a sense of uncertainty and these things make us feel uneasy. But the data show those are not always necessarily accurate with historic averages. So we'll be talking about that. So I listed here a few common financial worries: high cost of living, I don't have enough savings, job insecurity, debt, and political instability. So let's talk about each one of those. Let's start with the high cost of living. Let's ask this question, thinking about inflation today compared to historical averages, where do you think we stand? Okay, so we hear, inflation, high gas prices, food, and we're coming off it. We are lower in inflation today than a couple of years ago. I will say that for sure. But are we still high? Are we still average? Lower than average? Be interested to see what people are saying about that. So what do we have for people's comments here?
Okay, so we have, let's see here. Okay, so we have most voted is slightly higher than average. About almost 70% of people said that. Next up is at 20%. About people said about average. But yeah, most people slightly higher than average is what we're seeing.
I'm impressed. I think that the people that are listening in on these webinars, many of you have listened many times, right? And you're familiar with the tone and the topics we discuss. And so the responses, I think, are quite accurate. I think if you ask the regular person, they might be closer to A and B. So to see people coming in at C, B and C is more accurate, maybe slightly higher, about average. Let's see how this is the reality. The answer probably is closer to C. We're much more in line with the historic average. So if it feels like it's higher than average, that may not actually, and certainly people who feel like, wow, inflation is just out of control, they might be thinking about a couple of years ago when inflation it peaked in 2022 through it's been almost 4 years now. That truly was a time of really high inflation. But historically, inflation is 2 to 3%, and we're right there. So that should give us, I don't know, not necessarily it gives us confidence, but I think it helps put things in context. And so if you find yourself saying, man, things are so expensive these days, right? Or, man, prices just keep on going up and up and up. And there's a feeling of exaggeration and like, wow, this is somehow different. In actuality, inflation has always been there, and it always goes up a few percent a year. So we should expect that. And when it happens, rather than being concerned about it, I think accepting that that is the reality. And then based on that reality, then we need to figure out how to fend against inflation. Inflation is the long-term enemy to investing. So that's why we need to invest in stocks that have a strong correlation with inflation. Stocks go up, inflation goes up, right? Or I should say inflation goes up and stocks go up. Bonds roughly keep up with inflation. Cash typically doesn't keep up with inflation. Here's the long-term inflation numbers. You can see it peaked there in 2022. This is for the last 10 years. But now at 2.4, you can see that it's, this is, again, the last 10 years, the long-term historic average being, about 2.5%. We looked at a couple more. Let's see if we can go. Gas prices. In the last 6 weeks, of course, gas prices have spiked. We know that. But if you go back to the end of January, you're looking at, $2, is that $2? Gasoline, $2 a gallon or something. If you draw a line there at that 2 figure, I would say that's roughly average. Maybe the last few years have been a little higher, 2.5-ish. But, that will probably start to come down once there's some resolution in the Middle East. So the topic of the day, of course, is what's going to happen. And I wish we had more resolution. I think we can expect a lot more consistent ups and downs until this thing gets resolved. Yesterday was good because, you know, there were significant steps toward a ceasefire and toward a resolution. But as the reality sets in, the both sides are really still far apart on what they really value, what they want out of this situation. Iran is still holding a lot of the cards with controlling the Strait of Hormuz. United States, of course, has a lot of military strength, but Iran has shown to be, quite defensive there. I don't think Iran is wanting to back down anytime soon, but it doesn't serve their interest to have a war. It doesn't serve the United States. No one is served by this current war in the short term. Now, long term, we don't know the long-term impact politically, culturally, from a democratic standpoint, economically, we don't know. But in the short term, I think everybody kind of wants to get past this. And I think that will happen sooner rather than later. Gas prices then should probably come down. I think, did I miss something? Or maybe that's not. Oh, home prices. Where do you think home prices are now compared to the historic trend?
Okay, so we've got it live right now. We'll give it a few minutes here. I can see the votes flooding in. Here we go. Let's call it 5 more seconds, and we should have about 90% of the people voted. Okay, so we have most voted answer is A, far above the long-term historical trend. About half of the people voted for that, followed second by B, slightly above. But I'm pretty much everybody voted for far above or slightly above.
Yeah. Let's look at what the data show. Dating back to 1965, maybe that's actually 1960. If you draw a line, straight line, which would be the trend line, you can see that home prices have gone up consistently for many decades, right? In 2008, you can see it went down quite sharply because of the Great Recession. Then it started to rebound back up to historical norms. And then what you have here in 2020, that's where you see a massive spike, right? But then starting a couple of years ago, things have started to go down. If you look at where the end of the line is today, and you were to draw a line from 1960, I would say the answer is closer to slightly above. And if prices go down much further, if the last 3 years are any indication, if that continues downward, within a couple of years, we will return to a long-term historic average number. It just feels like why most people are answering A followed by B is because we tend to have a recent bias, right? We tend to think about things as they have been happening recently, and of course, it's difficult to ignore the massive spike we had a few years ago. But if these things tend to even out, there is regression to the mean, meaning a returning back to a natural rate of growth, whether it's the real estate market or whether it is the stock market, the bond market, gold, whatever the investment is, whatever the asset is, there are long-term averages that just there's kind of what I would call just the natural growth rate. And eventually, in the long term, there is regression. And so we want to find when there are things that are abnormally high or abnormally low, we want to pay attention to those for potential investment opportunities or warning signs. About mortgage interest rates. You know, a lot of people have stopped buying homes because mortgage rates are so high. We had a long time of really, really low. They've bounced up and they've just been holding here. Is that far above, a little above, in line with long-term, or below right now? How about mortgage interest rates today?
So
And today I think they're what, like
we've got,
6.5 or something like that.
yeah, we've got most of the votes coming in. It looks like most people are saying slightly above the historical average. About 70% of the people are voting slightly above. That would be
Yeah.
B.
I'm not surprised by that answer. But if you look at the long-term average for mortgage rates, again, I think if you were to draw a line, it might be closer to about 7. And I think we talked about this in prior webinars. I think that the average is about 7%. And I think we're now at about 6.5, right? So we are actually slightly below the 50-year average for mortgages. Thankfully, we are not in the 80s. In the 90s, things were obviously much higher then, even in the 70s, 80s, 90s. But, you know, you go back to, say, 2000 even, you're at 7.5. But again, we have this recency bias, if that's a word, but we tend to think of things compared to recent. And so since 2008, we're at about the same place we were in 2008, before the Great Recession. Then things dropped. They've hovered low for a long time. It's back. But at the end of the day, we're right now along historic averages. Let's talk about savings rates for a minute. Are Americans currently saving much more? Well, I guess much less, because they don't have money, right? There's a feeling like, gosh, I don't have any extra money, so I can't save. Slightly less, about line. So this is the savings rate. Are Americans saving more today compared to 30, 40, 50 years ago? About the same. Not saving as much.
I'm getting.
Oh, DJ, sorry, I can't hear you if you're talking. DJ, I'm not hearing you. Are other people hearing DJ? We give thumbs up if we hear DJ, or thumbs down.
I don't. Yeah, hold on.
Okay, I'm hearing you now.
Okay. Yeah, it's giving me an error message when I'm trying to do the poll. Oh, there we go. It says slightly less than average is what most people are voting.
Slightly less. People are saving slightly less. Okay. Let's look at what that shows. The personal savings rate, will forget about COVID. That's everything's weird in COVID. I think that that's accurate. And I think that's a reflection that people do have less money today than they did in the past. There is the long-term effect of inflation and just the cost of living is taking its toll over the decades. So when you look at 1960, 70, 80, 90, we're hovering at about a 10% savings rate. That has been cut in half since about 2000. So the a new rising generation of savers is saving, people my age, younger, are saving half as much as our parents did. So I think that that is a pretty significant decline of the average savings rate. And I think when people have money in savings, they feel a little more secure compared to when they don't have money for savings. This is both emergency savings and also long-term retirement income savings, that sort of thing. So when the savings rate is low for now 25 years, below historic averages, and I'm pretty certain if we went back to the 50s, 40s, 30s, prior generation that tended to save more, there has been a slow decline for sure. And so I think this is a translation to I feel less secure because I have less money saved. How about employment rate? Do you think unemployment is higher today? Average? And DJ, is that one working?
Yes, yes, it is working on this one. It worked a lot quicker. So we'll give it a couple of seconds to let some of the votes come in.
We have about 10 minutes left. We appreciate your participation in today's thing.
Okay, so
session.
most people are voting about average, but it's really close to much higher, much lower. This one's a very split between those three. Almost about average is slightly averaging or slightly above, but yeah, between much higher, much lower, or about average.
Yeah, you can see here, I would draw a line at 5%, and you can see we're about there. I'd say that we're about even with historic averages, if not slightly below. What I want to draw your attention to on this one, you will notice when there is a spike up, the spikes up happen pretty quickly. And this is something to be aware of in today's environment. There are some indications that the economy is slowing down and recession might be ahead. Although we'll talk in a minute that may not necessarily be accurate. But if things start to unravel and there are problems, things can unravel quickly with these spikes up. But then when these spikes up, whether it's 2008 or 1980 or 1990, in 2000, the dot-com, you have these spikes up and then it slows. So that's typical pattern. It's you start turn, you spike up, and then you return back to normal. But the trend over the last few years has been rising, and so the trend is problematic, but where we stand today is in line with historic averages. How about debt levels? What do we think about debt? We're talking consumer debt, credit cards, car payments, loans. You can even lump in housing if you want. Where do you think consumer debt levels stand today relative to historic averages?
We'll give it a few more seconds. About 60% of people have voted at this point. We've got most people voting completely out of control, and then the remainder are saying slightly elevated but manageable. No votes for C or D, so it's kind of split between A and B.
Okay. This is where, again, this feeling is, it's difficult to parse out the truth. This is where I would think it's closer to A than B. So what we have here is, this is the debt, total debt with non-housing and housing. So you can see housing debt is the biggest, right? So we'll talk about non-housing debt in just a second. But you go back to 2004, so that'd be 20 years ago, 2 years ago. In the United States, we had $8 trillion of total debt. And today, or a couple of years ago, we're at 19 trillion. So to go from 8 to 19 is almost what, 2.5%, like 2.5 times greater, 250% gain in overall debt. If the population would have grown 2.5 times, then that would be a neutral. But the population has not grown 2.5 times. The population in the last 20 years has grown about 15 to 20%. So we would expect 8 million to grow to, I don't know, 10 million or something like that. But the fact that it's grown to almost 20 trillion is alarming. And this is the single, perhaps the single biggest, but this is definitely a cause of concern. If we just look at the non-housing, we can see that student debt, and this really points to pressure on the young people. Student debt is that first one, really big pink. Car loan debt is also significantly more than in the past, and credit card debt has grown as well. So all these housing, credit cards, student loans, we have had a pretty big explosion of indebtedness, and that is putting the squeeze on savings. And so that is one of these data points that we look at that say, wow, the big picture, this is, I would say, a troubling sign, whereas some of the other things we talked about before are, business as usual. So we want to kind of pivot here in the last few minutes to this idea of markets climb a wall of worry. That's a saying that we have in the investment world. Is over time, the financial markets, stocks, bonds, real estate, other investments, they do go up in time, and they do that in the face of many worries. So if we say, oh, we're worried about X, today it's the Iranian war, tomorrow it's going to be something else. Last year it was, I don't know, 2 years ago it was inflation, 3 years ago it was this. There's always something to worry about, always many things to worry about. And so that's why investing is so difficult, because if we focus on the things that are in front of us and that are justifiably worrisome, what is happening in Iran today is worrisome, right? But that's the problem du jour. If it's going to be something else. And, in spite of that, the economy marches on. People are eating, people are watching TV, people are traveling, people are trying to, they need to get transfer. They need to move from point A to point B. So they need to have transportation. You have emerging economies in Southeast Asia, in Africa. These people are getting health care for the first time, good quality, food and things. You don't taste these things and back away. Society progresses, and that manifests itself in the markets. In the last couple of minutes, I want to talk about this feeling, and we see this in this one chart. There are a few ways to interpret what we refer to as the K-shaped economy, but if you go back for the last 5 years, you can see that historically, the red line is the stock market. The blue line is how people feel, consumer sentiment, okay? So this is the reality of again, just stock market, not necessarily real estate, but I think it would probably be real estate as well. So investments are shooting up since 2020, very dramatically, going up. But then consumer sentiment is down, I think the lowest on record. And so we sit here now at a case where, in fact, investments have been making money, but people feel so anxious. And I think only time will tell how this manifests itself, because at a certain point, the wall of worry is so big that people just stop spending. And that becomes a problem that is worrisome for the economy and does potentially translate to a recession. But as it's happening right now, there's just tremendous anxiety. But when we talk about investing, I would say that it is business as usual. And for the last couple of slides, I want to point to this idea of a recession. This is the short term. We follow regularly a concept called the anatomy of a recession. And there are, a dozen different data points. This is one particular, company or research company that we follow. And they look at these different things and they say, okay, is this a problem, a warning sign, neutral, or positive? And if you look over the last, several quarters, and you look at, March 31st, this includes through March, through higher gas prices, et cetera. overall, we are in expansion as an economy. And that's one reason why the stock market is still moving up. Companies are still making lots of money. Profitability is high, productivity, they're implementing AI, and they may not be hiring as many people, but companies are still making lots of money. It is a very good time to be investing. If you look over the last, many, many years, and they date this back to the last 50, 60 years, now hindsight is 2020, but you can see when there were problems like at 91, if you look at some of these in the middle columns, again, hindsight's 2020, but you look back, all of those things were signaling problem ahead, problem. And in fact, that ended up being a very difficult time economically. But then you look at today and it's like, no, the chances of recession are still relatively remote. And so the final takeaway here, and we'll end here, is we want to stay grounded. Perceptions and feelings often diverge from reality, but sometimes they're accurate, and that's why it makes it so difficult. Most economic indicators are consistent with historic norms. Business as usual. Uncertainty is not new. In fact, ironically, uncertainty is something on which investors can rely. Markets reward long-term discipline. It's generally best to make decisions based on a long-term, bigger perspective, stay the course kind of a mindset, rather than just on today's headlines. So even though it may be scary to stay the course in these times, the data would support doing so. And there are so many things to worry about these days. Hopefully you don't worry at all. But if you are worried, I don't think that the investments, Wall Street, your 401k, I don't think that is an area in which that requires any worry more than usual, right? I hope you can walk away from today's webinar and just say, you know what, it is what it is, business as usual, and now let me go out and make a good life for myself. We went over a few minutes. Were there any questions, or will no? Okay.
We did not have any.
No questions. Okay. Thank you so much. We will see you in 1 month. Thank you for your business. Thank you for participating today, and best wishes for a wonderful springtime. Take care.